You've probably heard people say invest early your entire life. And honestly, it's incredibly solid advice. But here's the glaring problem. Nobody ever actually explains how to do it. They never make it feel like something you, as a student or a young professional, can actually pull off without a fancy finance degree. Well, this explainer is going to fix exactly that. Over the next few minutes, we're going to break down the stock market in the absolute simplest way possible. I'm talking no jargon, no confusing fluff, and definitely no suits required. Let's get into it. So I want to kick things off with a really blunt question. Are you throwing away your time advantage? There's this concept in investing called the time advantage, and if you're under 30 right now, you absolutely have it. It's literally a financial superpower. But the crazy part is, most young people accidentally throw it right out the window. And it's usually just because they think, oh, I don't have enough money yet. But getting into stocks early is exactly how you lock in that advantage. Here is the biggest secret nobody tells you. The habit is what matters, not the amount. The stock market is not some exclusive VIP club just for the super rich or Wall Street insiders. It's really just a system designed to reward the people who start early. It genuinely does not matter what your starting salary is or what you majored in. Building the habit of investing is what actually unlocks wealth over time. Okay, so let's build that habit the right way. And to do that, we need to answer a pretty fundamental question. What are stocks, actually? A stock is simply a tiny piece of ownership in a company. That's the whole secret. When a massive brand, think Apple or Nike, wants to raise money to build new products or expand across the globe, they don't just walk into a bank and ask for a massive loan. Instead, they go to the public. They take their entire company and split it into millions, sometimes billions, of tiny little pieces called shares. And then they sell those pieces on the stock market. So when you buy one of those shares, you are literally becoming a part owner of that business. Now, what makes this so incredibly cool is how completely passive it is. And look, I know what you might be thinking. Wait, does that mean I can just strut into my local Apple store and demand a free charging cable because I'm an owner? Okay, no, you definitely cannot do that. But what you can do is perfectly summed up right here. If Apple grows and becomes more valuable, your piece of Apple becomes more valuable too. You didn't clock in for a shift, you didn't design the new iPhone, the company just grew, and your wealth grew right alongside it. You're basically just placing a bet that a company you believe in today will be worth more tomorrow. So how exactly does this translate into money in your bank account? Let's look at the two main ways stocks make you money. It really boils down to these two things. First up is price appreciation. This is super straightforward. Let's say you buy a single share for $10. Over time, the company grows, gets more successful, and later, that exact same share is worth $20. Boom. You just doubled your money simply because the company became more valuable. The second way is through dividends. Some companies actually take a chunk of their profits and share them directly with you every few months. They literally just send you cash as a thank you for being an owner. Now, while dividends are an awesome source of passive income, most beginners just focus on that first point, buying stocks and watching the price appreciate over time. And honestly, that is a fantastic place to start. All right, this brings us to the absolute best part of this explainer, your hidden superpower. Time. Get ready because this math is going to blow your mind. $350,000. Let me break down exactly how you get to this number because it's wild. If you are 22 years old right now and you invest just $100 a month into the stock market, that's it, just $100. And the market grows at its historical average of about 8% per year, in 40 years, you would have over $350,000. All from finding a way to set aside just $100 a month. And this right here perfectly illustrates why you simply cannot wait. Look at the difference. If you start at age 22, your growth is absolutely massive. But what happens if you put it off until you're 35 to start that exact same habit? You're still investing that same $100 a month, getting that same 8% return, but you end up with less than half the total amount. Waiting just a little over a decade literally costs you more than half your potential wealth. No way, right? So why on earth does this happen? 2 words: compound interest. This means your initial money makes gains, and then those gains start earning their own gains over and over and over again. It's like a snowball rolling down a massive hill. That huge difference between starting at 22 versus 35, it's not about being a financial genius. It's definitely not about being rich. It is purely the magic of compound interest doing all the heavy lifting for you. Time is what makes this math work. Okay, so enough theory. Let's get into the practical stuff. Here are 3 incredibly simple steps to get you started today.
if you want to cross the line from just thinking about investing to actually doing it, here is your game plan. Step 1, open a brokerage account. Step 2, buy an index fund or an ETF. And step 3, automate it. Notice what's completely missing here. We're not doing complex day trading, we're not staring at confusing charts all day, and we're not reading boring financial reports. Let's break these down.
Step 1 is getting a brokerage account. And honestly, this just means downloading an app on your phone where you can buy stocks. The accessibility we have today is amazing. If you live in Scandinavia, Nordnet is super popular. If you're elsewhere in Europe, eToro is a great, widely used option. And if you're in the US, Fidelity or Charles Schwab are fantastic choices. These apps are totally free to open, and I kid you not, it'll take you maybe 10 minutes to set up your profile. Step 2 is figuring out what to actually buy. Now listen to me closely. Please do not try to pick individual stocks as a beginner. Even professional Wall Street fund managers struggle to consistently pick winning stocks. There is zero reason for you to take on that kind of stress. Instead, you're going to buy an index fund or an ETF. An ETF is basically just a pre-made basket of stocks that tracks the entire market. By buying just one ETF, you instantly own tiny pieces of hundreds, sometimes thousands, of the biggest companies in the world all at once. It's instant, zero-stress diversification. And then we have step 3, which is the real secret sauce. Set it up once, and it just keeps going. You have to automate this. Set it up so that the day your paycheck hits or the money from your part-time gig comes in, $50 automatically transfers right into your brokerage account to buy that ETF. Automating it removes all the stress, all the second guessing, and all the temptation to spend it. You never even have to think about it because your financial future is literally building itself in the background.
Now, before you dive in, we have to talk about the final boss battle of investing, the #1 beginner mistake. We need to make sure you don't accidentally self-sabotage. Look at these two mindsets. The absolute wrong move, panicking and selling all your investments the second the market drops. And let's be real, the market will drop at some point. It always does. But historically, it has also always recovered. The right move is to treat market crashes like a 40% off sale. Think about it. If your absolute favorite clothing brand suddenly put their entire store on a massive, huge discount, you wouldn't panic and throw out the clothes you already own, right? No, you'd probably rush in and buy more. Market dips are the exact same thing. They're a literal sale on the world's best companies. The tricky part is they just feel really scary when they're happening. So here is your golden rule for surviving those scary drops. Don't check your app every day, invest consistently, and ignore the noise. The people who build real, life-changing wealth in the stock market aren't the ones trying to magically time the perfect highs and lows. They are simply the ones who stay in the game long enough to let compound interest do its job. So turn off the scary financial news, delete the app widget off your phone's home screen if it's stressing you out, and just let your automated habit run. Let's do a quick recap of what we just learned. Number 1, stocks are just tiny pieces of ownership in real companies. Number 2, time is your ultimate superpower. You don't need a huge pile of cash to start, you just need time for compound interest to do its thing. Number 3, start simple with ETFs to get instant, easy diversification. And finally, automate the whole process and stay the course, especially when the market gets bumpy. You don't need to be rich to start. You just need to start. Which leaves us with one final, super important question to think about. What is the one thing holding you back from investing right now? Seriously, ask yourself. If you're a student or a young professional, the best time to start is today, even if it's just with spare change. I really want to know what your biggest roadblock is, so drop a comment down below. I read every single one. Thanks so much for hanging out with me for this explainer. Now get out there and secure your time advantage.